Hey, good morning. Welcome to another edition of Coffee with Kirk. Appreciate you taking time out of your day. Sitting outside, so there's going to be a little bit of traffic on the road down a bit. If it's too much, let me know. I'll try to figure something out. We're just trying to find a quiet spot to chat today. Anyway, I was just going to go through a few things, just sort of a general overview of the market. I know the past couple of times I've just sort of focused on the transition from Picket Fence Financial to Bastion Fiduciary. I'm going to kind of avoid that this time and go back to all the great charts and all that good stuff that people like. So as we, as we enter into the new year here, got a couple of weeks in, got the new president coming in on Monday. Let's see kind of what the markets are telling us right now and, what seems to be working, what isn't. So we'll jump into the slides as we always do. Bring that up and we'll chat about that. Okay. So the big story right now, which you're not going to hear if you watch CNBC or really any kind of YouTube videos, everybody always talks about stocks. I've said it a million times on here. The real story is always bonds. Bonds are the big brother. The bond market is several times the size of the stock market. I always said the bond market is the smart money, stock market's the dumb money. So if you really want to kind of understand what's going on with the economy, what's going on with inflation, and really what's going on with asset prices, you got to look at the bond market. Well, right now we have the 10-year Treasury yield is going up. It's going up quite a bit. So we've been flirting with 5% on the 10-year Treasury for a little while here. And you can kind of see this move recently. Most of 24, the yield has been going up. And it's really started to climb, in the past few months. So what kind of story do bonds try to tell you? Bonds are really sort of two different stories. One, it could be a story of growth. So the fact that yields are going up means that we're seeing economic strength. And that could be what's happening. So the fact that if the economy is getting much better, then the stock market's probably going to do very well. And bond market's going to have to compete for capital with the stock market. So they have to offer better yields. That's sort of one of the theories. If you're an investor and the economy's growing, you might want to put your money into stocks because you can typically get a higher return. So if bonds can start to increase in yield, well, that might attract some of your capital because there is less risk, obviously, with bonds than with stocks. The next thing that bonds could be telling us is what is it about inflation? Because if you're a bond investor, you want to make sure that you're getting a yield from that bond, but you want that yield to hold its purchasing power relative to inflation. So if the markets are expecting more inflation, then bond yields are typically going to go up in order to protect the bond investors from inflation. And then there's always other little things that the bond market could be telling us. One of the big stories that a lot of people think about bonds and why the yields are rising is the fact that a lot of international investors are no longer putting money into bonds like they used to, especially China. China was the largest purchaser of our treasuries, our government bonds, and they're definitely pulling back on that. So is that causing an issue with yields having to rise to find new investors? And that absolutely could be the case. Now, the thing is, I throw out conjecture here. It could be this, could be this, could be this. And we don't really know until down the road. We won't really be sure if it's inflation, if it's just really going to be a booming economy, or if we're seeing some external factors that are affecting it, just people not putting money into treasuries. So, I mean, that's something that we'll look at, but definitely right now, as far as investment, this is a chart of the iShares 7 and 10 year treasury bonds. So these are pretty much intermediate term bonds. You can just see that's not a pretty chart. Basically straight down for a few months now. And it's had a bit of a spike here just very recently, but we'll see if that holds. But it's definitely not a very good investment chart here that you're looking at for intermediate and long-term bonds. Looks exactly the same. Now, this is short-term bonds. So these are treasury bonds between 1 to 3 years. So these are short. And the other thing, too, when you look at this chart, I would just want to point out that the numbers on the right y-axis there, it looks like a pretty big drop down, but that's a drop from 83 to 82. So 1 point. So it looks like a big drop, but it's not as far as a percentage. It's 1/80th. So you talk a little bit over 1%. But still, you can kind of see that, it has struggled a little bit as bonds have been struggling. It's not a pretty chart. You definitely don't want to be going in when things are heading directly south. But there's definitely a tighter window here with the fluctuation of the bonds. So, you try to look and see what's going on with bonds. What is it with the economy, really? What's going on? So there's some really good things to look at for the economy. There's some optimistic items that I'm seeing right now. Some people will say, well, Trump coming in is going to be good for the economy. So that's one thing. We'll see. I always say with presidents, any actions that they take have a lag time. So, for instance, President Biden talks about how we're producing more oil in the U.S. than we ever have. And honestly, a lot of that's due to what Trump did in his first term by loosening things. It takes a long time for exploration of oil wells to start to deliver. And you can't necessarily force that shot. We'll see what happens these next 4 years because the Biden administration sort of pulled back on exploration, especially offshore. Is that going to have an effect? These things take time to manifest themselves. So with Trump coming in now, even if he were to come in and make a lot of changes, it doesn't mean, even if they're right, they would have an immediate impact. The president taking over an economy is almost like a captain taking over an aircraft carrier. You really can't turn that thing on a dime. And the other thing to look at it is, imagine that aircraft carrier runs into some rough weather. It doesn't matter who the captain of that ship is. If you have rough weather, you're going to be bouncing around and you're not going to be able to go as fast as you'd want to because of the risk. So I'm always hesitant. People say, is Trump going to be good for the economy? Well, he could be. I mean, a businessman. But is he going to be good on day one? No, I don't think so. It takes time for anything to sort of get into the economy. Even tax cuts, which probably are the most immediate things you can do. If you were to have tax cuts, it still takes a little bit of time for people to adjust their policies, companies to adjust their policies to affect that tax, the new tax laws. So everything takes a little bit of time to fix or to improve or to degrade it. Now, one thing that is happening that is good for the economy right now is banks seem to be starting to loosen up their belts. I've been talking a little bit about last year how banks are starting to get tighter credit. They were not lending as much, and they were being a little bit more picky in who they lend to. So it seems like right now, the U.S. banks are starting to lend a little bit more again. across the board, it could be small businesses, mortgages, although there's not many mortgages happening, but car loans, credit cards. So that's always going to be good for the economy because you're getting more velocity of money is what we call it. So more money enters the economy, gets spent, goes to the next person, they spend it, so you start to pick up some velocity with that dollar that gets lent initially. So that's certainly a good sign for the economy. And you can kind of see, this is a chart now showing you before every big downturn that we had, '08, the tech bubble going all the way back 1990, and even right before COVID, those are all by the red dots there. You could see the banks started to tighten up their lending. And they also, again, like I said, last year in 2023 and 2024, they were tightening it up as well. So the fact that it's starting to loosen, we've never really seen a recession when banks have been letting more money come into the economy. Another thing is, the payroll number that came out recently was pretty good. They were expecting about 130,000 and it came in at 256,000. Now, I've talked about this a lot. I'm not a huge believer in the establishment survey. There's another survey, which is called the household survey. I'm not going to get into the nuances of employment. I've done that in the past. I'll do it in the future as well. So this number, I'm not as optimistic about that it's actually that much. But the fact is, we're not starting to see job losses or anything like that. That would start to, foretell a economic recession if we start to see those go down. Now, the unemployment rate is going up. It is trending up, but it has it at 4.1%. That's not really problematic at this point. So that's good. And you can kind of see maybe the markets are starting to realize this. So some of the sectors that are most attuned to what we feel like is the economy, one of them is we call it consumer discretionary. So these are going to be companies that obviously customers don't have to buy from this. This isn't something you have to do to feed yourself, to clothe yourself. Well, actually, I shouldn't say clothe. It's to feed yourself, to heat your house, all the basics like that. This would be pure discretionary. So it could be clothing. Clothing is clearly one thing you do not have to buy to live on. It's going to be a little bit more entertainment. It's going to be some travel things like that. So the market's basically right now saying, look, if things are good, and it seems like maybe they are, consumer discretionary is probably going to do pretty well. People are going to open up their wallets a little bit more. So that's what the market's seeing right now. And you can also see that when you look at the consumer staples. So the staples are the items that you're going to need no matter what. We're talking toilet paper, we're talking toothpaste, we're talking food, all of those kind of things that you're going to buy no matter what. And they have been struggling really as of late, really since Trump has come in or was elected. So, maybe the market's saying, look, we do think things are pretty good. And that's how the market started to position itself. Now, there's always going to be some positive signs to an economy and some negative signs. So one thing that does have me alarmed, and there's quite a few, but small business earnings are clearly dropping. So small business still is the backbone of the U.S. economy. And the fact that earnings are starting to drop a little bit should alarm people. Pretty much every economic downturn we've had, we've started to see a situation where small businesses were saying that their earnings are going down. Now, I do want to point out that this is a survey. This is not like a complete aggregation of every small business out there. This is more of going out and asking small businesses, a certain percentage of them, how are you doing? What do your earnings look like? What are your plans for the future? The other thing with this survey is it says they're not pulling in as many inventories, which is kind of a bad sign. So if you thought that things were good and you own a small business, you'd be buying more inventory to make sure that you can satisfy customer demand. But if you see inventories dropping, that's usually a sign that they don't see the strength of the consumer again, it's one of those, you have to wait and see what the true story is going to be. Any one of these items can change on a dime. The other thing I pointed out in past presentations is we're starting to see delinquencies climb quite a bit. This is just for credit card debt more than 90 days delinquent. Now you can see it's still not anywhere near where we were in, say, a 2008, 2009, but we're well above any kind of level we've been at since 2009. And I can show you this for automobiles, even housing starting to see some delinquencies rise, although not nearly what we kind of saw back in 2008 or even trending like what we're seeing now with credit cards or auto loans. But that's always kind of a thing that sort of tells you maybe the consumer's a little tapped. The other thing with the jobs report, while it was good, a lot of the jobs being created are government jobs. A job is a job, I guess, but you'd really like to see something other than government jobs, mostly because, right now with the fiscal situation that we're facing, adding more employment to that is not really a great thing. The other thing that had me alarmed mostly about the jobs number is we saw another 88,000 full-time jobs go away, and basically they went to part-time jobs. So, you want to see in a really good economy full-time jobs being added, not just some part-time stuff, because part-time employees, they can be dropped awfully quick. And I've talked about, too, how temporary jobs are dropping. So temp agencies are struggling because not as many people need temp employment right now. So we'll see. The one thing I do think is kind of starting to really show itself is that inflation is going to be an issue here for the foreseeable future. Now, it's not necessarily going to be that 9% inflation that we saw back in 2022, but generally the trend is up. And what this chart, it's a busy chart, but what it's trying to show you is the break-even rate. So we look at a 5-year Treasury inflated protected security. So we look basically, what do we think when we say break-even rate? We're going to compare tips to like the 5-year Treasury, and we try to say, what's the market pricing in for inflation? And you can kind of see going all the way back to 2009, all the way up until COVID, you had a much lower expected inflation rate. So sometimes tips were a good thing to buy, sometimes they weren't. So the red line is from 2009 to 2020. And you can see a lot of volatility on that, but the peak that it ever hit was the expected inflation got as high as 2.5%. But the overall average was about 1.6% is what they expected. So you could say we were expecting about 1.6% inflation. Well, since COVID has ended, you can kind of see what in the blue, what the anticipated inflation rate. Now, in that case, obviously, we jumped quite a bit up, as high as 4%. And really, the lowest that we were at was 1.9%. But the average here is about 2.5%. So, since COVID, we've had an elevated average of inflation, about 0.9%. Now, that doesn't seem like a lot, 0.9%. In one given year, that's not really all that big of a factor. But if we stay roughly 1% above the inflation rate that we've experienced before COVID, that starts to really add up because inflation is compounded. If you pay 1% more for goods and services this year, and then you do it the next year and the year after that, it starts to climb a lot faster. And it really starts to punish folks a lot more. So I definitely think we're looking at a situation where inflation is certainly kind of here to stay. And that could be one reason why we're seeing higher yields on bonds is the anticipated inflation as shown through the Treasury inflated protected securities is saying we're expecting more inflation. The other thing that we're starting to see, this is kind of a recent trend, is we're starting to see some of the asset classes that are affected directly by inflation, they are going up. So oil while oil went down quite a bit right after the election, because they anticipated that Trump would open up the spigots and let more exploration, be a lot more creative on, moving and manufacturing all the energy. But since then, we're starting to see oil start to come back up. Utilities had a little bit of a downturn, but they're spiking yet again. Utilities, while they're not completely a commodity play, they're more of a staples, but they are very heavily driven by the cost of commodities, clearly. This is one of the commodity holdings we've had in the past. This invests in the 24 most liquid commodities out there. So we're talking oil, natural gas, grains, livestock, precious metals, industrial metals. You can see that they're definitely heading up. So it's showing that we're expecting some inflation. And of course, gold's always seen as an inflation hedge. While gold has not really come down much in the past year or so, it's still holding up there, but it's kind of one of those assets that tend to do well, when we're in inflationary periods. And what's interesting about gold, it's really been on a tear here the past year and a half. But yet, if you look, all of the gold ETFs out on the market have actually seen outflows. People have actually, individual investors or even some, larger hedge fund money managers, institutional managers have been leaving gold, but yet the price has been going up. So that's kind of an interesting dynamic to it. It could be that central banks are buying a lot more gold. So we talked initially about China not buying as much treasuries as they used to. They're definitely buying more gold. And we're seeing that with the central banks. It could, the other reason it could be, I'm not really sure what other big reasons it could be. I mean, with the price of gold going up and outflows increasing, that's sort of an odd thing to see. But if we start to see money flow back in, we might see the price of gold really start to move. Another reason that this could be the case, some money has run to Bitcoin. So a lot of people see Bitcoin as an electric gold, an online gold. That could be another reason. But stock market overall, when Trump got elected, it went gangbusters for a little bit. You can kind of see in the middle of the screen there, the big move up. I don't have the months on the bottom. I apologize. I should have copied that in there. I didn't. But the big move up in the middle of the screen was when Trump got elected. So you can see there was a pretty sharp move up. But since then, we've really given it all back and then some. But the one thing you can definitely see is there's a lot of volatility. We're seeing a lot of moves up, a lot of moves down, but kind of a sideways overall. But we still have a situation that I've talked about in the past that really has me concerned. Is just the concentration of the stock market. The top 10 stocks, as far as a percentage of the U.S. stock market, it's well over 30% right now. So we're even getting to a point where we're starting to push 40%. So you're talking just a handful of stocks are the U.S. Stock market, and that's just never. When you get to these kind of levels, it doesn't hold, and it's really shows there's a lot of risk in the markets. We're at levels right now we haven't seen since the Great Depression, when there was just a few stocks really driving it back then. But you can even see, throughout, even into the 1950s and 60s, back then it was AT&T, GM, and IBM. Like those were the huge stocks that you had to own those, but they became such a big part. And then as we got into the 70s, all three of those really took it on the chin. And it wasn't necessarily that they were bad companies. Remember, I've said this before, the companies right now that are making up this enormous concentration, they're great companies. Apple, NVIDIA, Google, Amazon, they're great companies, but it's the valuations. It's what are you getting as an investor? What kind of cash flows? You can see it happen in the dot-com bubble. It sort of happened, the great financial crisis, but not nearly as bad. But we're kind of crazy situation. And what also has me a little worried is the amount of investment vehicles out there that can use leverage. We're seeing just a massive increase in the options out there. And a lot of these are built around the top 10 stocks that are driving so much of the market right now. So if you wanted to bet for, say, NVIDIA, you want to be NVIDIA, there's ETFs out there that you can get leverage on NVIDIA. You get twice the upside of what NVIDIA gets. There's some that if you think you need to go short on it, you think it's going to go down, you can get twice the leverage on that. Some of them have 3 times the leverage. So you're putting a lot of risky vehicles out there right now. You can see that the amount of money in these is just really crazy. A lot of them are coming to the market and drawing in tons of assets. So that has me a little nervous because leverage can work for you or against you. If you bet on NVIDIA going up and you leverage that, you're basically buying options to increase your potential outcome. That can work for you if it goes up, but if it goes down, you're going to lose a lot more. And that creates a situation where people, if things head south, people are forced to sell, which then compounds the situation. The other thing I've talked about this a lot is just how dominant the U.S. stock market is relative to the rest of the world. Right now, if you take the entire Morgan Stanley index weighting, we're 73% of the world's weighting on the stock market capitalization. So 73% of all the stocks in the world are U.S. based. That's awfully high. When you figure we're 5% of the population, and historically we're still about 50% of the world capitalization. So to put it in perspective, it's not outrageous for us to be half of the entire world's capitalization. It's been like that for decades, but right now we've boosted that up to 73%. And I've shown this chart before. This is just comparing U.S. to Europe, historical differences. Everything is cyclical in investing, and there's periods where Europe has done better than the U.S. and vice versa. But right now we're at such an enormous, I don't know if it's an overvaluation or just an extreme difference between the two. Now, I'm not saying that Europe isn't just a nightmare right now. It is. But still, when you get to these kind of extreme levels, it has to make you take notice. But like I said, I mean, right now, international is not very good. This is one of the internationals that I really like. This is the Franklin International Core Dividend, and we've held this. I've sold most of it for clients. But I mean, it's not a good chart to be looking at right now. It's definitely a downtrend. It's below the 200-day moving average, which is the light green right there. So it's definitely not a place that you'd want to be invested at this point. So I've kind of stayed away that. Right now, the only international I've got is some India. I've got an ETF that's focused on growth companies in India. It's still struggling a little bit, but it's hanging in there. But international right now is just not a place to be. At some point it will be, but again, we talked valuations in the U.S. stock market are really, really high. And we're now higher than we were during if you look at price to sales, we're higher than we were during the tech bubble, definitely higher than the great financial crisis. And if you look to price to book, so what is book again? Book is basically all of the assets of the company. So when you look at the price of the stock, what's it compared to all of the hardcore assets that company holds? And we are, once again, at this point, we're up where we were back at the dot-com bubble. So it's a scary time to be invested in U.S. stocks. And the last thing I'll show you here is we call this the Buffett indicator. And this just takes the value of all publicly traded stocks and you divide it by the gross domestic product, which is the size of the economy. And obviously, the economy, we mentioned this earlier, small business is still the core of the U.S. economy. So when your value of publicly traded stocks, which is a very small percentage of the total companies in the U.S., when their value is twice that of the entire economy, you're getting to a pretty high valuation there. Even at the tech bubble, we hit about 140%. And then the great financial crisis wasn't all that bad. It was about 110%, I think. So Buffett looks at this and uses this as a indication if the market's overvalued or not. And, you have to wonder what it's looking like when even like Goldman Sachs is sort of predicting like the next 10 years might see a 3% return on the S&P 500. So, when some of the Wall Street folks are sounding a little bit bearish, that should alarm you. So, the thing you always have to focus on, and I've talked about this, it hasn't worked the past few years, but you want to look at value. People forget that when you invest in a company, what you're investing in is a future stream of earnings. That's what you're looking at. Doesn't have to be a sexy stock. If it's giving you money, that's what you want. If you're going to look at buying a rental property, you shouldn't be too enthralled if it's on the beach, if it's in the mountains. You want to know, what's it going to pay me? So a home sitting in the middle of Iowa in a very nondescript area, if it's paying you more money than, say, a beautiful beach home, then the smart investor is going to buy that place in Iowa. And so what you probably have to be focused on is finding good value. Companies are paying you money. And one of those ways is dividends. Dividends have always kind of been a very great way to benefit as a stock investor. This chart just kind of shows you between dividend payers and non-dividend payers, sort of what you'd look like for an annualized return, and also the standard deviation, which is the measurement for risk. So by focusing on dividends and value, you're going to get a higher return over time. And again, that has not happened here really since 2009. We haven't seen that. It's been the stocks that have the sizzle, that have the story. But over the longer term, you're going to be better rewarded focusing on dividends, not only from a return aspect, but from a risk. So you can see that the annualized risk, 17% versus 29%. So a lot less volatility in all of these. So that's what you want to kind of focus on. This is just another chart going back to 1973 through 2021, showing you again sort of the return based on dividends and non-dividends, but also companies that are growing their dividends or starting dividends. They typically have higher returns and exhibit less risk. Companies that just pay dividends still show very good returns and less risk than the general market overall. Companies that have no change in their dividend policy, well, you're down to 7% at that point, still a little bit less risk. But then if you get the companies that aren't paying the dividends, you see over time that return's not all that sexy and the volatility is much higher. But then when you look at companies that end up having to cut their dividend or eliminate it completely, that's usually a sign that they're in trouble. And you can see from that, you get usually negative returns over time with a lot of volatility. Now, I don't want to say that cutting dividend is always a bad thing, but sometimes, kind of foretells what's really happening. So right now, as I look at things, you want to stay in shorter term bonds. We've had a lot in treasury bills, and even with the Fed cutting rates, it's still, you're still getting pretty close to what you could get if you invested in 10-year. You could still get 4.6%, whereas the 10-year treasury is closer to 5%, but you're going to have a lot less volatility. In fact, you're going to have very low volatility. So, on a risk basis, I think it's a lot better. Now, if 10 years get up to 5.5% or something like that, where it really starts to affect the stock market, that might be time to step out into longer dated bonds, just to get that. Because at that point, we're probably not going to go up too much. If we really see the stock market come down because yields have gone up to 5.4, 5.5%, you're probably a good time to lock into some 5.5% yields at that point. The other thing, right now, inflation seems to be kind of coming back a little bit here. Like, part of it is the fact that the Fed has cut rates. The markets start to say, well, maybe inflation is coming in. Some people also think that Trump's policies, he's going to spend a lot of money, which will be inflationary. So investments like gold, commodities, utilities, oil should do pretty well. As I laid out, value and dividend focus is probably something you should be looking at. I'm definitely going to add a little bit more to some value positions and some dividend focused positions. Again, they haven't worked out. Like, they have sort of sat there doing nothing, but you're buying in things that with a low price to earnings, lowest price to sales, lower price to book, and you're getting paid to wait. As we talked about in the past, Warren Buffett has been sitting on just a ton of cash. He's sitting in T-bills just waiting. And Warren Buffett's outperformance isn't strictly because he's a very good stock picker. It's mostly because when things get rough, he comes in and buys. So he's always buying when people are panicking. So he's building up a big war chest of cash. Right now, internationals, while valuation-wise, it's great. It's just not really performing all that well. There's still some really good areas of international that I think will do pretty well. And as we do this merger to Bastion Fiduciary, I'll definitely have Loretta Reeves come on and talk about her philosophy on international value. One area that is doing okay is India. It's doing pretty well. The other thing I'm going to add, and I'll get more specific on this in the next Coffee with Kirk, but some hedges. I've talked about buffer ETFs. So they're basically using options to invest in the stock market. They give you a much more knowable outcome. So without getting into it too much, it can kind of protect you on the downside. It can give you, up to 25% or more protection to the downside and give you a good portion of the upside, not all of the upside. So if the market goes up 25%, you may not experience a 25% upside, but you might get 10 or 11%. So that could be a way right now to kind of get some exposure to the market without taking on all of the risk to the downside. And as always, we're going to finish with our disclaimer. Lawyers say hello. So if you're not a client, make sure you do your due diligence. And I try to make sure I put out as best information as I can here. So hopefully it's reliable data. Okay. So let's see what we've got for some questions. Where are you right now? I am actually down in Florida visiting family for a couple of days. It's a little chilly for Florida. I'm sure most Floridians are wearing winter coats, but I find it to be pretty nice because, like you, Rob, I'm heading back tomorrow for very cold weather. So it looks like you've got your 4 inches of snow, and we've got that Arctic blast coming to everybody up in the north. If the U.S. market is overpriced, where should we invest? Well, there are sectors, like I said, in the U.S. market that can do well. Value has sort of just been languishing. I've talked about a ton. Oil, energy stocks right now are still really cheap. You're talking price to earnings below the historical average, and they're paying dividends on top of that. So that's one sector that's really a great area to be in. Going to be adding some, now that we are starting to see oil come back up, going to be adding some oil into client portfolios. I mean, international is a good place to sit if you could be patient, because its valuations are pretty good. And when I say the valuations, I mean actual earnings. So we're still looking at the money coming to you as an investor. So those areas have been pretty good to, if you're willing to wait a little bit. I don't know when the craziness in the U.S. will slow down at all, or when investors will start to look at cash flows a little bit more seriously. But at some point they will. They always have. And the more extreme things get, the closer we are to the end. Will you have a portfolio manager bash and appear on the show? We're going to have a lot of that. We're going to really focus on the folks that are managing the money. Right now we have 3 portfolio managers. I just mentioned Loretta Reeves. Also, we call her Retz. She's our international value. So she really takes a different approach. She's worked for Sir John Templeton. So really comes from a really good resume. We'll definitely have her on. Cale Smith, who is going to be the CEO of Bastion. He manages a deep value fund, which has become almost an energy fund. So the vast majority in there are energy holdings. We'll definitely have him talk. And then finally, we brought in John Rotanti, and you hear J-Row a lot. We call him J-Row. He worked at the Motley Fool, was their lead analyst there, trained other analysts at the Motley Fool, and he's a value investor too. He calls it an industrials value, but when you get into how he identifies industrials, it's much broader in scope than what like you typically think of with industrials. So we'll definitely have, a lot of that coming to you guys, so you can see what's happening. And we'll talk more about how all this works. It's gonna be kind of for clients slowly integrating that in. We're gonna have what's called a core and explore strategy. So we'll still have a core, the very sort of passive ETFs, lower cost, captures the market or the asset class that we want, bonds, commodities, whatever it is. And then for the explore part, we'll be a little more active. And obviously right now that a lot of that's going to be dividend focused, or not dividend, but value focused, which a lot of those are dividend based. But our plan is to add more managers as time progresses. So we may have a tech growth. We may have an industrial growth, all kinds of different managers, so that maybe somewhere down the road, we'll be able to build, complete portfolios with all the asset classes, for clients that way. So, that's sort of the goal. But for right now, it's going to be more of a core and explore strategy, what we call it. Okay, so I think we hit all the questions. I hope everybody has a great weekend. Definitely stay warm out there, folks. I think if you're definitely north of the Mason-Dixon line, you're going to be experiencing a pretty cold snap here for a bit. And like I said, I came down for a couple of days to Florida just to visit family. My daughters had some time off, and they want to come down, go to Busch Gardens and all that good stuff. So we just came down for a quick trip. So we're heading back to the cold. And have a great weekend, everybody. Take care.